Hello and welcome to our YouTube channel Gistopedia. In this video, we will be providing you a summary of the book The Psychology of Money by Morgan Housel. This book is a fascinating exploration of the relationship between psychology and personal finance. The book explores different concepts about the money, like the importance of recognizing the role of luck in financial success. Housel argues that while hard work and good decisions are important, luck plays a significant role in our financial outcomes. By acknowledging this, we can avoid feelings of entitlement or disappointment and focus on making smart financial decisions that align with our personal values and goals. Another essential concept in the book is the power of compounding. Housel emphasizes that small changes in our financial habits can have a significant impact on our long-term wealth. By starting early, avoiding debt, and consistently saving and investing, we can take advantage of the power of compounding and build significant wealth over time. The book also explores the difference between being rich and being wealthy. Housel argues that being rich refers to having a high income or net worth, while being wealthy means having the ability to sustain a desirable lifestyle without relying on a high income or net worth. By focusing on building wealth rather than simply accumulating riches, we can achieve long-term financial security and peace of mind. The book also discusses the importance of financial freedom, which Housel defines as having the ability to make choices based on what you want to do, rather than what you have to do. Financial freedom provides a sense of security and reduces stress, and can be achieved through a combination of saving, investing, and living below your means. The book also explores a variety of other topics related to personal finance and psychology, including the impact of our personal beliefs and biases, the dangers of blindly believing financial advice, the importance of planning for unexpected events, and the value of working together and seeking out trusted advisors. Throughout the book, Housel provides relatable examples and engaging anecdotes to illustrate his points and drive home the importance of understanding our individual psychology when it comes to money. Whether you are a seasoned investor or just starting on your financial journey, The Psychology of Money is a must-read that will challenge your perceptions of money and inspire you to take control of your financial future. The book is divided into 20 chapters, each covering a unique topic related to money and psychology. These chapters are filled with relatable examples and practical advice which challenges the readers to rethink their approach to money and wealth. Chapter 1 of the book sets the stage for the rest of the book by exploring the concept of personal finance and the role that psychology plays in our financial decisions. The chapter is titled "No One's Crazy" and emphasizes the importance of recognizing that everyone has a unique perspective on money, and no one's perception is inherently wrong. One of the key concepts in this chapter is the idea that our beliefs and biases can impact our financial decisions in ways that we may not even be aware of. For example, Housel shares the story of a man who was reluctant to invest in the stock market because he had a fear of losing money. While this fear is not uncommon, it caused the man to miss out on significant long-term gains that he could have earned by investing in the stock market. Housel also emphasizes the importance of recognizing the role of luck in financial success. He explains that while hard work and smart decisions are important, luck plays a significant role in our financial outcomes. For example, a person may have made a wise investment decision that yielded a significant return, but this success could have been due to luck rather than skill. To illustrate this point, Housel shares the story of a successful investor who made a fortune by investing in Japanese stocks in the 1980s. While many people attributed the investor's success to his skill and foresight, he himself acknowledged that much of his success was due to luck. Specifically, the fact that he happened to be investing in Japan at a time when the country's economy was booming. Chapter 2 of the book is titled Luck and Risk and explores the intersection between luck and risk in personal finance. The chapter emphasizes the importance of recognizing the role of luck in our financial outcomes and understanding the difference between good luck and bad luck. One of the key concepts in this chapter is the idea that risk and uncertainty are inherent in personal finance, and that we cannot eliminate them entirely. Housel explains that even the most carefully planned financial strategy can be impacted by unexpected events or market fluctuations. For example, a person may have invested in a diversified portfolio of stocks and bonds with the goal of minimizing risk, but this strategy may still be impacted by unforeseen events such as a global pandemic or a major economic downturn. Housel also explores the difference between good luck and bad luck, and how our perception of luck can impact our financial decisions. He explains that while good luck can lead to financial success, it can also lead to overconfidence and entitlement, which can be detrimental in the long run. On the other hand, bad luck can lead to feelings of victimization and despair, which can also have negative consequences. To illustrate these concepts, Housel shares the story of a successful entrepreneur who attributed much of his success to luck, despite having worked hard and made smart decisions. The entrepreneur acknowledged that he had been fortunate to have been born in a stable country with access to education and opportunity, and that his success was due in part to these external factors. By recognizing the role of luck in his success, the entrepreneur was able to remain humble and focused on making smart financial decisions. Chapter 3 of the book is titled Never Enough and explores the concept of enough in personal finance. The chapter emphasizes the importance of defining what enough means to us individually, and understanding how our beliefs and values impact our financial decisions. One of the key concepts in this chapter is the idea that the pursuit of wealth can become a never-ending cycle if we do not define what enough means to us. Housel explains that many people fall into the trap of believing that more money will lead to greater happiness, but this is not always the case. In fact, research has shown that beyond a certain point, increasing income does not lead to a significant increase in happiness. Housel also explores the idea of hedonic adaptation, which refers to the tendency for humans to quickly adapt to positive changes in their lives and return to their baseline level of happiness. For example, a person may feel a temporary boost in happiness after purchasing a new car, but this feeling will eventually fade as they become accustomed to the new car and its features. To illustrate these concepts, Housel shares the story of a man who was a successful investment banker, but was never satisfied with his income. Despite earning millions of dollars per year, the man was always chasing after more money and never felt fulfilled. Eventually, he realized that he had defined enough in purely financial terms and had neglected other aspects of his life, such as family and relationships. Chapter 4 of the book is titled Confounding Compounding and explores the power of compounding interest in shaping our financial future. Housel argues that the power of compounding is one of the most important concepts in finance, yet it is often overlooked or misunderstood. Compounding occurs when the interest earned on an investment is reinvested, leading to exponential growth over time. This means that even small contributions made consistently over a long period can lead to significant wealth accumulation. One of the key concepts in this chapter is the idea that time is a crucial factor in compounding. The longer an investment is held, the greater the potential for compounding to take effect. Housel illustrates this concept by comparing two hypothetical investors, one who starts investing at age 25 and another who waits until age 35 to start investing. Despite investing the same amount of money, the investor who starts earlier ends up with significantly more wealth due to the power of compounding. Housel also explores the impact of fees and taxes on compounding, highlighting how even small fees or taxes can significantly reduce investment returns over time. He emphasizes the importance of minimizing fees and taxes to maximize the benefits of compounding. To further illustrate the power of compounding, Housel shares examples of people who have achieved significant wealth by consistently investing over a long period. He also provides practical tips for readers to start harnessing the power of compounding in their own financial lives, such as by setting up automatic contributions to a retirement account or by avoiding high-cost investment products. Chapter 5 of the book is titled Getting Wealthy versus Staying Wealthy and explores the differences between accumulating wealth and preserving it over the long term. Housel argues that becoming wealthy is relatively easy compared to staying wealthy. Accumulating wealth often involves taking risks and making bold moves, such as starting a business or investing in the stock market. However, once wealth is accumulated, the challenge becomes preserving it over the long term and avoiding common pitfalls that can erode wealth. One of the key concepts in this chapter is the importance of humility and avoiding overconfidence when it comes to managing wealth. Housel argues that overconfidence can lead to taking excessive risks or failing to adequately diversify a portfolio. He provides examples of successful investors who fell victim to overconfidence, such as long-term capital management and Bernie Madoff. Another important concept in this chapter is the idea of avoiding lifestyle inflation. Housel explains that lifestyle inflation occurs when people increase their spending as their income rises. This can lead to a situation where people feel as though they need to maintain a certain level of spending to maintain their standard of living, even if it is not sustainable over the long term. Housel argues that avoiding lifestyle inflation is key to staying wealthy over the long term. To further illustrate the importance of staying wealthy, Housel shares examples of wealthy individuals who fell from grace due to poor financial management or excessive spending. He also provides practical tips for readers to preserve their wealth over the long term, such as by avoiding debt, maintaining a diversified portfolio, and practicing frugality. Chapter 6 of the book is titled Tales, You Win, and explores the role of outliers in personal finance. The chapter emphasizes the importance of recognizing the impact that extreme events, both positive and negative, can have on our financial outcomes. One of the key concepts in this chapter is the idea that outliers, or extreme events, have a disproportionate impact on our financial outcomes. For example, a person who invests in the stock market for 30 years may experience relatively consistent returns, but a major market crash or boom can significantly impact their overall performance. Housel explains that these extreme events, or tales, are often unpredictable but can have a massive impact on our financial outcomes. Housel also explores the idea of asymmetrical risk and reward, which refers to the idea that the potential rewards of an investment may be much greater than the potential risks. For example, investing in a startup company carries a high level of risk, but the potential rewards may be massive if the company becomes successful. To illustrate these concepts, Housel shares the story of a man who invested in a single stock that became a massive success, leading to him becoming a multi-millionaire. However, Housel also shares the story of a woman who invested in a single stock that became a massive failure, leading to her losing her entire life savings. Both of these stories illustrate the impact that outliers can have on our financial outcomes. Chapter 7 of the book is titled Freedom and explores the relationship between money and freedom. Housel argues that financial freedom is not just about having enough money to cover basic expenses, but also about having the ability to make choices and live life on our own terms. One of the key concepts in this chapter is the idea that freedom is not just about having more money. Housel argues that it is also about having a sense of purpose and meaning in our lives. He provides examples of people who have achieved financial freedom, but are still unfulfilled because they lack a sense of purpose or direction. Another important concept in this chapter is the idea that financial freedom is not an all-or-nothing proposition. Housel explains that even small steps towards financial freedom, such as paying off debt or saving a small amount each month, can have a big impact over the long term. He encourages readers to focus on making small, consistent improvements in their financial lives rather than trying to achieve financial freedom all at once. To further illustrate the importance of freedom, Housel shares examples of people who have achieved financial freedom and are using their wealth to make a positive impact in the world. He provides examples of philanthropists who have donated large sums of money to charitable causes and individuals who have used their wealth to pursue meaningful projects and hobbies. Chapter 8 of the book is titled Man in the Car Paradox and explores the idea that money can be both a tool for achieving our goals and a source of anxiety and stress. The chapter begins with a story about a man who buys a luxury car, only to find that it brings him more stress than pleasure. Housel uses this story to illustrate the idea that our desires and expectations for material possessions are often shaped by social norms and expectations, rather than our own personal values and goals. One of the key concepts in this chapter is the idea that money can be a two-sided mirror, reflecting both our aspirations and anxieties. Housel argues that while money can provide a sense of security and freedom, it can also create a sense of anxiety and inadequacy if we feel that we don't have enough of it. To overcome this paradox, Housel suggests focusing on our personal values and goals, rather than external pressures and expectations. He encourages readers to think about what truly brings them joy and fulfillment, and to align their financial decisions with those values and goals. Housel also explores the concept of hedonic adaptation, which refers to the tendency to quickly adapt to new levels of wealth or luxury, and to continue to desire even more. He argues that this can create a cycle of never-ending consumption and dissatisfaction, and suggests that focusing on experiences rather than possessions can help break this cycle. To illustrate these concepts, Housel shares examples of people who have found happiness and fulfillment through simple, low-cost experiences, and who have been able to break free from the cycle of consumption and dissatisfaction. Chapter 9 of the book is titled Wealth is What You Don't See and explores the hidden costs and benefits of different financial decisions. Housel argues that wealth is not just about the visible signs of wealth, such as expensive cars or luxury homes, but also about the hidden benefits of financial decisions. One of the key concepts in this chapter is the idea that financial decisions have both visible and invisible costs. Housel explains that visible costs are easy to see and understand, such as the price of a car or a home. However, there are also hidden costs, such as the opportunity cost of investing that money elsewhere or the cost of maintenance and repairs for a luxury item. Another important concept in this chapter is the idea that wealth is often the result of small, incremental decisions that compound over time. Housel uses the example of Warren Buffett, who has achieved his wealth through a series of small, intelligent investment decisions made over many years. To further illustrate the concept of invisible wealth, Housel provides examples of people who have achieved financial success by making unconventional decisions. He cites the example of a man who decided to live in a small apartment and ride a bicycle to work instead of owning a car, which allowed him to save and invest more money over time. Chapter 10 of the book is titled Save Money, and explores the importance of saving and the different strategies for doing so. Housel argues that saving is a fundamental component of financial success, and that the ability to save money is often more important than how much money one earns. One of the key concepts in this chapter is the idea that saving is not just about cutting back on expenses, but also about making intentional decisions about how to spend money. Housel emphasizes the importance of having a clear understanding of one's values and priorities in order to make informed decisions about spending and saving. Another important concept in this chapter is the idea that small, incremental changes can make a big difference over time. Housel provides examples of how small changes, such as bringing lunch to work instead of eating out or cutting back on subscriptions and memberships, can add up to significant savings over time. To further illustrate the importance of saving, Housel provides examples of people who have achieved financial success by making saving a priority. He cites the example of a man who worked as a janitor for many years and lived a frugal lifestyle, but was able to accumulate a large nest egg through consistent saving and investing. Chapter 11 of the book is titled Reasonable Greater Than Rational, and explores the idea that being reasonable, rather than strictly rational, is often more beneficial when it comes to making financial decisions. Housel argues that rationality is often limited by human biases and emotions, while reasonableness takes into account these factors and allows for more flexibility and adaptability. He suggests that being reasonable means being willing to adjust one's expectations and goals based on changing circumstances and new information. One of the key concepts in this chapter is the idea that it's important to balance rational analysis with emotional intelligence. Housel suggests that emotions are a crucial component of decision-making and that ignoring them can lead to poor financial decisions. Instead, he encourages readers to acknowledge their emotions and use them as a guide for making reasonable decisions. To further illustrate the importance of being reasonable, Housel provides examples of successful investors who were able to achieve financial success by being reasonable in their decision-making. He cites the example of Warren Buffett, who is known for his ability to make reasonable, rather than strictly rational, investment decisions. Chapter 12 of the book is titled Surprise, and focuses on the role of unexpected events in shaping our financial lives. Housel argues that surprises are a fundamental part of life, and that they can have a significant impact on our financial well-being. While we can never predict everything that might happen, Housel suggests that we can prepare ourselves for the unexpected by adopting a flexible and adaptable mindset. One of the key concepts in this chapter is the idea that it's important to have a safety net in place to protect against unexpected events. This could include having an emergency fund, insurance policies, or a diversified investment portfolio that can weather market downturns. Housel also suggests that it's important to be proactive in seeking out surprises and being open to new opportunities. He suggests that we should embrace uncertainty and view unexpected events as potential opportunities for growth and learning. To illustrate the importance of being prepared for surprises, Housel provides examples of individuals who were able to overcome unexpected events and emerge financially stronger as a result. He cites the example of J.K. Rowling, who went from being a struggling single mother to a billionaire author after her Harry Potter series unexpectedly became a huge success. Chapter 13 of the book is titled Room for Error, and explores the importance of having a margin of safety in your financial planning. The chapter emphasizes the idea that unexpected events such as job loss or health problems, can impact our finances, and that having a cushion of savings or other resources can help us weather these storms. One of the key concepts in this chapter is the idea of the fragility of complex systems. Housel explains that many aspects of our financial lives are complex systems, and that unexpected events can cause these systems to break down. He argues that by building in a margin of safety, such as having an emergency fund or investing in a diversified portfolio, we can protect ourselves against unexpected shocks. Housel also explores the concept of opportunity cost, which refers to the potential cost of choosing one option over another. He argues that when it comes to financial planning, it is important to consider both the potential benefits and the potential risks of any given option, and to weigh these against the opportunity cost of not choosing another option. To illustrate these concepts, Housel shares examples of people who have experienced unexpected events that impacted their finances, and who were able to navigate these challenges because they had built in a margin of safety. He also shares examples of people who have missed out on opportunities because they were too focused on avoiding risk, and who later regretted not taking the chance. Chapter 14 of the book is titled You'll Change and explores the concept of how people's values and priorities can change over time, and how this can impact their financial decisions. The chapter emphasizes the importance of being open to change, and of being flexible in your financial planning in order to adapt to changing circumstances and priorities. One of the key concepts in this chapter is the idea that our financial priorities and goals are often shaped by our life experiences and the people we surround ourselves with. Housel explains that as we grow and evolve as individuals, our financial priorities and goals may shift accordingly, and it is important to be aware of this and to be willing to adapt our financial plans as needed. Housel also explores the concept of sunk costs, which refers to the tendency for people to continue investing in something simply because they have already invested time or money into it, even if it is no longer in their best interest to do so. He argues that it is important to recognize sunk costs, and to be willing to let go of investments or financial decisions that are no longer serving our best interests. To illustrate these concepts, Housel shares examples of people who have experienced significant life changes, such as job loss or illness, and who have had to adapt their financial plans accordingly. He also shares examples of people who have realized that their financial goals or priorities have changed over time, and who have adjusted their plans accordingly. Chapter 15 of the book is titled Nothing's Free, and explores the concept of hidden costs and unintended consequences in our financial lives. Housel argues that there is no such thing as a free lunch and that everything has a cost, even if it's not immediately apparent. For example, buying a cheaper car may save money upfront but could result in higher repair costs down the line. Similarly, taking on debt may provide immediate benefits but could lead to long-term financial stress and reduced options. One of the key concepts in this chapter is the idea that there are often unintended consequences to our financial decisions. Housel suggests that we need to consider the second and third order effects of our choices and decisions, beyond just the immediate benefits. To illustrate this point, Housel provides examples of individuals who made financial decisions without considering the hidden costs and unintended consequences. He cites the example of a homeowner who took out a large mortgage on a home without considering the impact of rising interest rates or the potential for job loss. Housel also suggests that it's important to consider the opportunity costs of our financial decisions. For example, investing in one asset may mean missing out on potential gains in another. Housel suggests that we need to weigh the costs and benefits of our decisions carefully and consider all the available options. Chapter 16 of the book is titled You and Me and emphasizes the role of social norms, peer pressure, and personal relationships in shaping our financial behaviors. Housel argues that our financial behaviors are not only driven by individual factors like income, education, and personality, but also by the social environment we find ourselves in. He suggests that we often look to others to determine what is normal or appropriate when it comes to money, and that this can influence our decisions and behaviors. To illustrate this point, Housel provides examples of how social norms can impact our financial behaviors. He cites the example of how the perception of what constitutes a normal house has changed over time, leading to higher spending on housing. He also discusses how peer pressure and social comparison can lead us to make decisions that we may not have otherwise made, such as buying a luxury car or taking an expensive vacation. Housel suggests that one way to combat the negative impact of social norms on our financial behaviors is to cultivate a personal finance culture among our friends and family. By openly discussing money and sharing financial goals and strategies, we can create a supportive environment that promotes positive financial behaviors. Chapter 17 of the book is titled The Seduction of Pessimism and explores the impact that negative thinking can have on our financial decisions. The chapter emphasizes the importance of staying optimistic and focusing on the long term when it comes to investing and personal finance. One of the key concepts in this chapter is the idea that pessimism can be seductive because it can feel like a form of protection. Housel explains that people often focus on worst-case scenarios and become overly cautious as a way of protecting themselves from potential losses. However, this kind of thinking can also prevent people from taking risks and making investments that could ultimately lead to long-term gains. Housel also explores the idea of time diversification, which refers to the idea that the longer an investment is held, the less risky it becomes. This is because over time, the impact of short-term market fluctuations becomes less significant, and the overall trend of the investment becomes more clear. To illustrate these concepts, Housel shares the story of a man who started investing in the stock market in the late 1970s, just before a major market downturn. Despite the initial losses, the man continued to invest over time and ultimately built significant wealth through the power of time diversification. Chapter 18 of the book is titled When You'll Believe Anything and explores the idea of how people can be susceptible to believing in financial myths and misconceptions, despite evidence to the contrary. The chapter emphasizes the importance of being skeptical and critical of financial information and seeking out unbiased sources of information to make informed decisions. One of the key concepts in this chapter is the idea of confirmation bias, which refers to the tendency for people to seek out information that confirms their existing beliefs and ignore information that contradicts them. Housel explains that this can be particularly dangerous in the realm of finance, where myths and misconceptions can spread quickly and become widely accepted, despite lacking evidence or logic. Housel also explores the concept of financial literacy, which refers to the knowledge and skills needed to make informed financial decisions. He argues that improving financial literacy can help people recognize and avoid financial myths and scams, and make more informed decisions about their money. To illustrate these concepts, Housel shares examples of common financial myths, such as the belief that investing in the stock market is just like gambling, or that renting a home is always throwing away money. He explains how these myths can be misleading or inaccurate, and how they can lead people to make poor financial decisions. Chapter 19 of the book is titled All Together Now. Author Morgan Housel brings together the key concepts from the book to provide a holistic view of how psychology and personal finance intersect. Housel emphasizes that personal finance is not just about numbers and spreadsheets, but about the underlying beliefs, values, and behaviors that shape our financial lives. He argues that understanding the psychological factors that influence our financial decisions is crucial for achieving long-term financial success and happiness. One of the main themes of the book is the importance of avoiding financial mistakes, rather than trying to chase after big wins. Housel argues that avoiding mistakes is more important because financial setbacks can be difficult to recover from, and can have long-lasting negative consequences. Another key theme of the book is the power of compounding. Housel illustrates how even small savings or investments, when compounded over time, can lead to significant wealth accumulation. He also highlights the importance of taking a long-term view when it comes to investing, and avoiding short-term thinking or trying to time the market. Housel also emphasizes the importance of understanding our own biases and emotions when it comes to money. He notes that we often make financial decisions based on our emotions rather than rational analysis, and that being aware of our biases can help us make more informed decisions. Finally, Housel discusses the role of relationships and social norms in shaping our financial behaviors. He suggests that cultivating a positive financial culture among our friends and family can be a powerful tool for achieving financial success and happiness. Chapter 20 of the book is titled Confessions, in which the author Morgan Housel presents several confessions related to money, investing, and personal finance. These confessions are based on Housel's experiences and insights gathered over the years as a financial writer and advisor. One of the confessions Housel makes is that he still makes financial mistakes despite writing about money for a living. He explains that no one is perfect, and even experts make errors when it comes to handling their finances. Another confession Housel shares is that he finds it difficult to predict the future of the stock market or specific investments. He explains that while many people are obsessed with trying to predict the future, it's often more helpful to focus on the things we can control, such as our savings rate and investment strategy. Housel also confesses that he doesn't believe in get-rich-quick schemes or chasing the latest investment trends. He explains that the most successful investors are often those who follow a simple, long-term strategy, rather than those who try to time the market or take on unnecessary risks. Finally, Housel confesses that he believes personal finance is ultimately about more than just money. He explains that while money is important, it's just a tool that can help us achieve our goals and live the life we want. Ultimately, he argues, it's important to focus on the things that truly matter, such as family, friends, and experiences. The confessions presented in this chapter serve as a reminder that money and investing are complex topics, and that even experts don't have all the answers. However, by staying focused on our goals and making smart decisions with our finances, we can create a more secure and fulfilling future for ourselves and those we care about. Thus, The Psychology of Money is a must-read for anyone who wants to gain a deeper understanding of their relationship with money. The book explores a wide range of topics related to personal finance, including the importance of time, the value of humility, and the dangers of overconfidence. The author uses real-life examples and compelling storytelling to make complex concepts easy to understand and relatable. One of the most important takeaways from the book is that wealth isn't just about money. It's about having the freedom to live life on your own terms and pursue the things that truly matter to you. The book also emphasizes the importance of saving and investing wisely, but not at the expense of living a fulfilling life in the present. If you found the summary of this book helpful, please visit my YouTube channel for more book summaries and content that can help you enhance your knowledge and expand your horizons. I strive to provide quality summaries that are both informative and easy to understand. Don't forget to like and subscribe to stay updated on new content. Thank you for watching.